price to earnings multiple, also known as the PE multiple, or just the multiple. They all refer to the same thing. And it's the cornerstone of how we value stocks and compare them against each other. Whenever you hear talking heads pontificate about how some stock has become overvalued or undervalued, well, they're really talking about the price earnings multiple. When you hear someone say that Pepsi is more expensive than Coke, they don't mean that Coke is cheap when it could be trading in, say, the 50s, while Pepsi is pricey when it's trading in, say, let's call it the 130s. The share price tells you nothing about a stock's valuation vis-a-vis another stock. To make any kind of apples-to-apples comparison, you have to take a step back and look at the multiple. And I know this isn't easy. I know that my mom always got confused when I was at Goldman. She always tried to figure out whether one stock was more expensive than the other based on the dollar amount, and that was not right. So you got to think about it like this. When you buy a stock, you're actually paying for a small piece of a company's future earnings stream. So to value a stock, you have to look at where it's trading relative to the earnings per share, EPS, which you'll often see rendered as the EPS line. And that's what the multiple lets you do. Okay, so here's the basic algebra. It's not even math. It's something any fourth grader could manage. The share price, letter P, equals the earnings per share. E times the multiple M. The multiple tells you how much investors are willing to pay for a company's earnings. It's the most basic form of valuation analysis. A stock that sells for 20 times earnings is cheaper than a stock that sells for 25 times earnings. Or to put it another way, the multiple is the special sauce of valuation. The main ingredient in that sauce, growth. How much bigger the earnings will be next year than this year, and the year after that, and the year after that, and so on. The stocks of companies with faster growth tend to get rewarded with higher price to earnings multiples. Why? Remember, the multiple is all about what we're willing to pay for future earnings. And the more rapidly a business grows, the bigger its earnings will be a few years down the road. So let's just take one. Let's take a fast grower like Chipotle, okay? Let's say it's trading at more than 40 times earnings. Now, that doesn't necessarily make it more expensive than a slow but steady grower like a PepsiCo if it's trading at something like 22 times earnings, because that's not relative. You have to make it relative. Chipotle deserves the bigger price to earnings multiple because it has a much, much higher growth rate. Now, here's where it really does get interesting. Multiples aren't static. In different markets, people will pay more or less for the same amount of earnings. When they pay more, we call that multiple expansion. And when they pay less, it's called multiple contraction. Two more items that sound much more complicated than they really are. That's what hedge funds are trying to gain when they play a sector rotation. Of course, the earnings aren't static either. When you buy a stock, you're either making a bet that the E or the M part of the price equation is headed higher.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.